Hello everyone, it is James O'Reilly here from Northeast to give you an important update with regard to the state of markets right now and address a question I'm getting asked an awful lot at the moment, which is, should I be holding on to my stocks? Should I be buying more? What's the play right now? Now, just before I jump in, of course, for those of you that are not clients, this is a general advice. There is a general advice disclaimer here. This is general advice only. It doesn't take into account your own needs or situation. Obviously, the ASX has fallen very significantly, the Australian share market. Globally, we've seen massive falls. 30% is where we are sitting at the moment after going down as far as about 37 or almost 40% actually. So we're now starting to enter this area whereby, again, more commonly, we're getting asked, what do we do right now? Are we accumulating more? So this video is ultimately designed to just give you a bit of an overview as to the cases for selling right now, and also the cases for buying right now to help you refine your thoughts around the most appropriate course of action. So firstly, if I may, let's get started with the case for selling. There are three particular things I want to draw your attention to right now that are not speaking positively in terms of how attractive the share markets look right now. The first one is the fact that COVID-19 case numbers are still growing all over the world. Now, if we, top left-hand corner, Australia, we've done pretty well for the most part with our lockdowns and our measures. Because it hasn't really taken off, we've sort of caught it early, and that's been hugely beneficial to date. If we compare that with the US, for instance, which is obviously in this top right-hand corner, they're facing a much bigger problem and a much more serious problem. However, this is still very important for you as an Australian investor, and that is because the US market represents an enormous component of global markets. And if the US is having an awful time of this, so will Australian share markets, so will global share markets. So irrespective of what happens here, this is going to be a very big driver in terms of your portfolio returns. Now, I've added two more charts down here just because I think they're valuable from an observational perspective. The first one is Italy, where, of course, we've had some absolutely horrible events unfold there in terms of not only the case numbers, but also the deaths. One of the things that you observe here with Italy is Italy were one of the first countries to enforce a lockdown. Right now, it's basically our equivalent of a stage 4 lockdown. If you want to leave your home, you need a written note. If you don't have a written note, that's a €3,000 fine. So they really have done their best to dial it up as much as they can here. What we have seen, though, is that even though the lockdown commenced in early March, we are still seeing a very stubborn persistence of cases. And this is a problem. This is a problem in that it's demonstrating that in first world countries, if it does get a real grip in the country, it's very, very hard to purge. It takes a very, very long time. And that's particularly significant for Italy, and it's also significant for the US, as we were talking about before, because by all metrics, it looks like the US is in a similar situation in terms of just how rampant COVID-19 might be in that country. Lastly, down here in Italy, this is, for me, the canary in the coal mine, so to speak, and that's because if you look at a number of countries like India and the Philippines and these sorts of countries, what you notice is that the data, it certainly doesn't have the beautiful linear sort of numbers that other countries like the US and Germany and in Italy and to an extent Australia do. My concern here is that this is reflective of the fact that they do not have the ability to measure how serious this problem is. And therefore, this might be much, much more serious than the number of confirmed daily cases at any given time. I've already said in previous videos that if COVID-19 does run rampant through countries, particularly third world countries that don't have the medical capacity to resolve this or don't have the ability to quarantine their people, this is going to be a huge long-term problem because it will just continue to rear its ugly head until we have ultimately vaccines available to resolve the problem, and that's not going to be any time in the short term. The number two reason that the case for selling right now is around the medium-term impact of recession. It's all but a fait accompli that we are going to experience a recession in the next quarter. Now, this is the US market. I couldn't find the data for the Australian market. Many of our clients have already seen this slide, But if you look at the orange bars down here, this is from 1926 all the way through to 2016, I believe, and 2017. And these orange bars here represent recessions. Now, what you can see is that recessions don't always create significantly negative years. However, we also note that in the periods of time where a bear market, a significant period of negative return, these orange areas down here, when that traces downward and then creates a recession, it's not uncommon for that bear market to continue for another year or even longer at times. Now, of course, there's other times whereby before the recession has ended, the recovery's already started. So this isn't a case that happens all of the time, but it certainly does signify that if we are in a period where in the medium term we're facing recession, historically that means that as a country we have high unemployment rate, we have a whole host of problems that are created for our country, and also in terms of the just the success of our country as a whole, which in many ways is measured by the success of our share market. So putting all of that together, it's a pretty compelling reason, again, to certainly not have a trigger finger right now with respect to getting straight into the markets. And the last thing here is around the long-term impact of the stimulus packages that have been released. This is as of Feb 29, 2020. It's expected that this number is going to exceed 900 trillion. That's going to be the level, 900 billion. That's going to be the level of government debt by the time that we get to the end of some of the stimulus packages that have already been declared. And of course, at some point in time, we've got to try to unwind that. Now, with last year, you might recall I released a video around deficits and why government deficit was important in budgets, surplus and deficit. And that's ultimately just indicating a surplus means that we've got enough money to start paying down this debt. And a deficit means we don't have enough, and debt's going to increase. And as you can see, we've been in deficit continually for some years now. This is now going to see a very, very strong, aggressive line, almost vertically, based on this very sudden, very significant spending. Now, if we want to try to rein that in, it's going to be a lot like weight loss. You know, if you want to lose weight, it's all about caloric deficit. You need to have more going out than coming in. And this is going to be the same. If we're trying to tighten the belt buckle here and trying to rein in this debt, this means less going out. It means going forward that, for instance, the tax breaks that were one of the centerpieces of the Liberal government's election campaign, 2022, 2023, reducing personal income tax rates, reducing company tax rates. I'd say pretty comfortably that those are in the bin now. I think that it's very, very unlikely that they are going to get delivered. And then equally, in terms of other taxes, that just as a whole, I think there's a very, very high likelihood that we're going to go through a period of perhaps paying more tax, not just personally, but also through companies. If companies are paying more tax, that means that they're less profitable. If they're less profitable, that impacts the share price. So again, in terms of long-term outlook, if we are trying to unwind this debt, we have to cut the fat somewhere. And the concern, of course, is that is ultimately going to weigh down the economy somewhat as we continue to make a recovery of sorts. So let's now move across to the case for buying. Again, jumping straight into this. The first one is that there are stimulus packages. The fact that the government has offered such enormous economic support to date indicates that they are very, very committed to making sure that these economic downturns do not decimate the economy. And that in many ways is very good. The market has certainly responded very well to these significant government packages getting put forward. The fact that this is happening is excellent if you're on the pro-buying side, and as well as the fact that it's in for a penny and for a pound in many respects. Now that they've started these stimulus packages, it's very reasonable to think that they will continue them until they are in a position whereby they can confidently say that this crisis has resolved somewhat. Number two is that volatility is settling, finally. So what we're looking at is the volatility index chart, which basically tracks just how crazy the market is at the moment. Now, what you'll see, the volatility indexes here up at 55. These are unprecedented highs. This is just batshit crazy volatility. And what we're seeing finally is that this is starting to subdue. This is nowhere near normal levels, but it's starting to trace downward. And that's a reflection of the fact that the instructions to brokers are less and less often being just sell everything I want to get out of here, and they're more often being a case of let's consider this in a measured way, let's look at our portfolio in its entirety, and let's make the best decisions rather than just irrationally panic selling everything. These numbers are panic sell territory. There's still no shortage of concerns and very, perhaps irrational behavior with volatility this high. However, the good thing again is that this is pulling back, and as volatility continues to subdue, and the hope is that it will continue to subdue, well then that makes share investing more attractive for investors, which ultimately allows prices to again start to increase. And the last and the most, in my opinion, strong case for why you should be buying right now is the fact that right now we have a 30% discount available compared to market peaks only 2 months ago. Something I'm really encouraging a lot of clients to do at the moment is that idea of zooming out. And it's very, very easy in this world with the volatility that we have to focus on what's happening each day or by the week or even to an extent by the month. But if we start to zoom right out of this and take a long-term view over the last 30 years, for instance, which is what I've got here, I think 36 years of data, you start to see that over the long term, getting in after significant falls often pays very, very high returns thereafter. For that reason, our view right now is that we are absolutely in a state of accumulate. I don't believe that now is the time to just put all of your money on the table and say just buy whatever we can, because I think that there are some real headwinds that I've already outlined earlier that could ultimately mean that prices become even more depressed in the future, or we see a prolonged glut of staying down at this price point before the market starts to return to previous highs. Having said all of that, if we're taking a long-term view again, I think there's the idea of starting to make purchases and continually making purchases through this time makes a lot of commercial sense. Thank you, everyone. I really appreciate your time today. It goes without saying, if you want to discuss any of this, then please feel free to get in touch with me. I'm pretty sure all of you have my email address, but there it is. If you want to have a phone conversation, then I kindly ask that you punch this link into your phone or your computer, and that will allow you to pick a time when we are both free for me to give you my full attention, and I'm sure we'll have a great conversation thereafter. Thank you, and have a great day.